Something just shifted in the financial markets that hasn't happened in over 2 decades. And right now, while you're watching this, major institutions are repositioning billions of dollars based on this signal. I'm talking about the gold to silver ratio, and it just broke through a critical level that historically precedes massive wealth transfers. If you've been paying attention to precious metals lately, you've probably noticed something unusual. Gold keeps hitting new all-time highs, but silver? Silver's been acting like it's got somewhere important to be. And the relationship between these two metals, the ratio that traders have relied on for centuries, just flashed a signal that's making some of the smartest money managers on Wall Street move faster than we've seen in years. Here's what we're going to break down. First, I'll explain exactly what this ratio means and why it matters more than most people realize. Then we'll look at what just happened, the specific breakdown that's got institutions scrambling. After that, we'll examine the historical patterns because this isn't the first time we've seen this signal, and what happened afterwards was extraordinary. Finally, we'll discuss what this means for different types of investors and what the actual data is telling us about where things might be headed. But before we dive deep, let me give you the context you need to understand why this matters. The gold-to-silver ratio is elegantly simple. It tells you how many ounces of silver it takes to buy 1 ounce of gold. Right now, as I'm recording this, that number has dropped to levels we haven't seen since the early 2000s. When gold trades at $2,600 and silver at $32, the ratio sits around 81. But here's the thing, that ratio used to be above 90 just months ago. And in March 2020, during the pandemic panic, it spiked to 125. That was the highest level in recorded modern history. So why does this number matter? Because it's essentially measuring the relative value between two assets that have served as money for thousands of years. When the ratio is high, silver is historically cheap compared to gold. When it drops, silver is gaining ground fast. And institutions pay very close attention to this relationship because it often signals broader shifts in market sentiment, inflation expectations, and industrial demand. Think of it this way. Gold is the monetary metal, the safe haven, the asset central banks hoard. Silver is the hybrid, part monetary metal, part industrial commodity. It goes into solar panels, electronics, medical equipment, and electric vehicles. So when the ratio moves dramatically, it's telling us something about both monetary policy fears and real economic activity. And here's where things get interesting. The breakdown we just witnessed isn't just a technical chart pattern. It's backed by physical movements of metal that would be impossible to fake. Let me explain what I mean. Over the past 6 months, we've seen record withdrawals from silver ETFs, not because investors are selling, but because institutional buyers are taking physical delivery. The COMEX, where silver futures trade, has seen its registered inventory, the silver actually available for delivery, drop to multi-year lows. Meanwhile, mints around the world are reporting delays in silver coin production because they can't source enough physical metal fast enough. At the same time, gold hasn't been sitting still. Central banks bought over 1,000 metric tons of gold in 2023, the second highest annual purchase in history. China, Russia, India, Turkey, they're all adding to reserves. But here's the twist. Even with this relentless gold buying, silver is outperforming on a percentage basis. That's the ratio compression we're seeing, and it's unprecedented in modern markets. The last time silver moved this aggressively relative to gold was in the lead-up to 2011. Back then, silver went from around $18 per ounce in late 2010 to nearly $50 by April 2011. That's a 178% gain in roughly 5 months. Gold went up too, but nothing like silver's explosive move. The ratio collapsed from around 65 to below 32 at the peak of silver's run. Let's go further back because these patterns repeat with striking consistency. In 1980, during the Hunt brothers' attempt to corner the silver market, the ratio briefly touched 17. Silver hit $50 while gold traded around $850. That was an extreme outlier, fueled by market manipulation. But the broader trend was clear. When inflation fears grip markets and monetary uncertainty rises, Silver moves faster than gold on the way up. The 1970s stagflation period offers another data point. From 1971, when Nixon closed the gold window, to 1980, gold rose from $35 to $850, a 24-fold increase. Impressive. But silver went from $1.30 to $50, a 38-fold increase. The ratio collapsed from 27 to 17 during that period. Silver, with its smaller market and industrial uses, simply moved more violently. Now, I'm not suggesting we're about to see $50 silver next month. What I am saying is that when this ratio breaks down through key support levels, the historical precedent suggests we're in the early stages of a significant repricing, and that's exactly what institutions are positioning for right now. But here's what most people miss about institutional buying. They're not buying because they think prices will go up next week or next month. They're buying because they see structural changes in supply and demand that will take years to play out. And right now, both supply and demand dynamics for silver are setting up in a way we haven't seen in decades. On the supply side, silver mine production has been essentially flat for years. Most silver comes as a byproduct of mining other metals like copper, lead, and zinc. When those primary metals aren't economically viable to mine, silver supply drops. And with energy costs elevated and ore grades declining globally, new silver supply is becoming more expensive to bring to market. Meanwhile, demand is accelerating from sectors that didn't even exist 20 years ago. Solar panel installation is projected to double by 2030. Each gigawatt of solar capacity requires approximately 100 metric tons of silver. Electric vehicles use roughly twice as much silver as traditional combustion engine cars. 5G infrastructure, medical applications, water purification. The industrial demand story for silver is strengthening right when supply growth is stagnant. The Silver Institute estimates that industrial demand will create a supply deficit of over 200 million ounces annually by 2025. That's being filled by above-ground stockpiles for now, but those stockpiles are finite. When they're depleted, price has to rise to either incentivize new supply or destroy demand. That's basic economics. So what are institutions actually doing? Because actions matter more than speculation. Let's look at the evidence. First, filings from major hedge funds show increased positions in both gold and silver mining stocks, but the weightings have shifted. Funds that traditionally held predominantly gold miners are now adding significant silver exposure. Sprott Asset Management, one of the most respected names in precious metals, has been vocal about silver's setup. Eric Sprott himself has been buying silver companies and physical silver on a scale that's unusual even for him. Second, look at the derivatives market. The options chain for silver shows something fascinating. There's been a massive increase in call buying, options that profit when prices rise, at strike prices significantly above current levels. We're talking about institutional-sized trades betting on silver at $40, $45, even $50. That's not retail speculation, that's informed money-taking positions. Third, physical premiums tell the story. The premium you pay for physical silver above the spot price has remained elevated even as prices have risen. Normally, when prices go up, premiums compress because there's less buying pressure. But that's not happening. Premiums on silver eagles and other physical products remain stubbornly high, indicating sustained physical demand that's not reflected in paper markets.
And this brings us to a critical point that changes everything: the divergence between paper silver and physical silver markets. This is where it gets technical, but stay with me because this is important.
The COMEX silver market trades hundreds of millions of ounces in paper contracts daily. But the actual physical silver backing those contracts? It's a fraction of the paper claims. This works fine when everyone's trading contracts back and forth. But when buyers start demanding physical delivery, the system gets stressed. Recently, we've seen delivery requests spike. In some months, delivery requests have approached 20% of registered inventory. That might not sound like much, but in a fractional reserve system, it's enormous. If this trend continues, we could see a situation where there literally isn't enough physical silver to satisfy delivery requests, forcing a cash settlement or a dramatic price adjustment. This is exactly what institutions are positioning for. They're not just betting on price going up gradually. They're positioning for a potential squeeze scenario where the paper market loses credibility and price has to adjust violently to reflect physical scarcity. Think about what happened with nickel in 2022. The London Metal Exchange had to halt trading and cancel trades when a short squeeze pushed prices up 250% in a single day. That was embarrassing and unprecedented, but it showed what happens when paper claims exceed physical availability. Silver has much larger markets and more liquidity, but the structural setup shares similarities. None of this is happening in a vacuum. The macro backdrop is critical to understanding why this ratio breakdown matters now. Central banks globally are stuck in an impossible position. Inflation has proven stickier than anyone expected. The Federal Reserve and other major central banks raised rates aggressively, but now they're discovering that high rates create their own problems. Government debt service costs are exploding. Commercial real estate is underwater. Regional banks are sitting on massive unrealized losses. If they keep rates high, something breaks in the financial system. If they cut rates significantly, inflation could reignite. And if they print more money to bail out failing institutions or monetize government debt, well, that's exactly the scenario that drives people toward precious metals. We're already seeing cracks. The Fed had to intervene when Silicon Valley Bank collapsed. They created a new facility to provide liquidity to banks. That's quantitative easing by another name, and markets know it. That's why gold has been making new highs even with interest rates well above zero. Normally, higher rates are negative for gold because gold doesn't pay interest. But when markets lose faith in fiat currency stability, gold goes up regardless of rates. Silver, with its monetary and industrial dual nature, benefits from both dynamics. The monetary fear drives safe haven demand, while actual economic activity, especially in green energy and technology, drives industrial demand. It's the perfect storm. But here's the part that should really get your attention. We're still in the early innings of this move. Let me show you why. If we use historical ratio compression cycles as a guide, we've barely begun. The ratio has dropped from 90 to 81, roughly a 10% move. In previous cycles, ratio compression didn't stop until the ratio reached the 50 to 60 range or lower. If that happens this time, it means either gold has to fall significantly, which seems unlikely given central bank buying, or silver has to rise dramatically. Let's do the math. If gold stays at $2,600 and the ratio compresses to 55, that puts silver at $47 per ounce. That's a 47% gain from current levels around $32. If the ratio compresses to 45, like it did briefly in 2011, that's $58 silver. Now, if gold continues rising while the ratio compresses, the numbers get even more interesting. Assume gold reaches $3,000, which many analysts consider reasonable given monetary instability and geopolitical tensions. If the ratio sits at 55, that's $54 silver. At a ratio of 45, that's $67 silver. These aren't wild-eyed predictions, they're just mathematical outcomes if historical patterns repeat. And institutions know this math. That's why they're positioning now, before the move becomes obvious to everyone else. By the time retail investors pile in, which typically happens when prices are already screaming higher, the smart money has already accumulated positions. Now, I'd be doing you a disservice if I didn't mention the risks and counterarguments, because nothing in markets is certain, and precious metals can be volatile and frustrating investments. First, industrial demand could disappoint. If we enter a significant global recession, demand for electronics, vehicles, and other silver-intensive products could drop. That would increase supply overhang and potentially keep prices suppressed despite monetary factors. Second, central banks could pull off the impossible and engineer a soft landing. If inflation comes down without triggering a recession, and if they can normalize monetary policy without breaking anything, the fear trade that drives precious metals would diminish. Gold and silver could pull back significantly. Third, there's always the possibility of market manipulation or intervention. The precious metals markets have a history of price suppression allegations. Whether you believe those claims or not, the reality is that large, concentrated short positions and paper market dynamics can keep prices depressed for extended periods, even when fundamentals are bullish. Fourth, silver is a much smaller market than gold. This cuts both ways. It means silver can move more explosively higher, but it also means it can crash harder. The 2011 spike to $50 was followed by a brutal bear market that took silver down to $14 by 2020. That's a 72% drawdown that lasted nearly a decade. Anyone who bought near the top and held experienced substantial losses. So perspective matters. This is not a short-term trading call. It's an observation about a structural setup that could take months or years to fully play out. And even if the thesis is correct, the path will be volatile and frustrating at times. Let's talk about what this actually means for real people with different situations and goals. If you're a conservative investor focused on wealth preservation, the gold-to-silver ratio breakdown suggests that holding some precious metals exposure makes sense as portfolio insurance. Maybe that's a 5 to 10% allocation split between physical gold and silver, or shares in established mining companies. The goal isn't to get rich, it's to protect purchasing power if currency debasement accelerates. If you're a more aggressive investor looking for asymmetric upside, silver and silver mining stocks offer that potential. The leverage in mining stocks can be substantial, both up and down. When silver moves from $32 to $40, a 25% gain, some silver miners can double or triple because of operating leverage. But the reverse is also true. These are volatile instruments that require conviction and risk management. If you're a trader, the ratio itself can be traded. When it's historically high, you could buy silver and sell gold, betting on compression. When it's historically low, reverse the trade. This is an advanced strategy that requires understanding of futures markets and hedging, but it's how sophisticated institutional players extract value from the relationship. For most people, the actionable takeaway is simpler. Understand that we're potentially in the early stages of a multi-year repricing of precious metals relative to fiat currencies. How you position for that, or whether you position at all, depends on your personal circumstances, risk tolerance, and conviction. But here's what I keep coming back to. The institutions moving right now, the ones repositioning billions of dollars, they have access to information and analysis that far exceeds what you or I can compile. They employ teams of PhDs studying supply chains, demand trends, monetary policy, and geopolitical developments. When we see this level of coordinated positioning, when we see physical metal leaving vaults, when we see options activity pointing to much higher prices, and when we see a technical breakdown in a ratio that's held for decades, we should at minimum pay attention. This doesn't mean rushing to buy silver coins tomorrow. It means taking the time to understand what's happening, looking at your own portfolio allocation, and making an informed decision about whether precious metals fit your strategy. The channels and sources that consistently track these developments, that dig into the data beyond just looking at price charts, those are valuable resources, because markets reward preparation and punish complacency. The institutions already know this. The question is whether individual investors will recognize the signal before the move is fully priced in. So let's bring this all together. The gold-to-silver ratio just broke through a key support level that hasn't given way in over 2 decades. This breakdown is backed by physical movements of metal, institutional positioning, supply-demand fundamentals, and a macro backdrop that's increasingly supportive of hard assets. History shows us that when this ratio compresses, silver tends to dramatically outperform gold. We saw it in the 1970s, in 2011, and in shorter cycles throughout modern market history. The setup right now, with supply constraints, increasing industrial demand, monetary instability, and institutional accumulation, mirrors those previous environments. Does this guarantee that silver goes to $50 or $60? Of course not. Markets are probabilistic, not deterministic. but the odds have shifted meaningfully in favor of significant appreciation over the coming months and years. The institutions are already moving. The physical market is already tightening. The ratio has already broken. The question isn't whether something is happening, it's whether you understand what it means and how to position accordingly. As markets continue evolving and this situation develops, staying informed becomes crucial. The moves are happening now, the data is available, and the pattern is becoming clear to anyone willing to look beyond surface-level analysis. The ratio just broke. Institutions are moving fast. The only question that remains is what you'll do with this information. Because by the time everyone sees what's happening, the opportunity will have already moved. If this breakdown of market structure and institutional positioning was valuable, you'll want to stay connected with what happens next in these markets. Make sure you're following along so you don't miss the next major development, because in markets like these, the biggest moves happen fast.